Hi everybody, this is Seth and welcome to this week's Middle Class Investor. Thanks for joining me today. Well, we had a pretty down week, I would say, in the financial markets. We're looking, this chart I have up here is the Dow. It's the 5-year chart, and we've been talking about this upper trend line, this red line up here. And this line connects the 2000 highs with the 2007 highs, and as you can see here, each one of these is a week. In most recent weeks, it's been dancing all around this line and finally gave way to the line, and looks like it's retesting the lower trend line now. So to me, the Dow is the one that it's probably the one that we should be focused on. The S&P is more diverse, and a lot of times it's better to look at. It's what some people call it's the boss, but the S&P also looks. What's interesting about the S&P, we've had this wedge, this rising wedge, which is bounded by these two red lines right here. We've had this rising wedge on the chart really ever since I started making these videos, and I personally have had this wedge on the chart for even much longer. So what's interesting is it kind of messed with this upper trend line, broke down, and came just to the other side of the wedge, this lower trend line, before it reversed and went the other way. So the question is, and I think it's too early to say, but the question is this the sell-off we're waiting for, or is this just another correction with another move upwards? The reason it could be the sell-off is because we've already kind of broken out of the upper, and usually once you test this upper line in a rising wedge, or any pattern for that matter, once you kind of get what's called a fake out, so this would be a breakout right here. This here, let me zoom in a little bit. This this bar, well, let me scooch down right here. Okay, this bar right here would have been a breakout, or you could call this one the breakout, but this one looks more decisive. But once you get a breakout and the market kind of tucks its head back in, it's like a turtle sticking its head out, and then it kind of pokes its back in. But it looks like we tried it several weeks in a row, and then you made this last attempt, and then boom, sell off. So this is kind of what when I'm trading or invest, I look at this and I call it I look at it as a fake out. So but the market, nobody really knows. Just because I call it that doesn't mean anything. So but what is interesting is how it sold off and stopped just short of this line before it resumed back up. So the question is, what to expect now? I mean, are we going to see new highs, something up here around 2010 or 2020? Or are we going to see, something like this with a little pull back into here, maybe up a little higher? Now there's on the S&P there's a gap. There's a gap at this 1970 area. So a lot of times these gaps get filled, and of course you can see right now we're at 1955.06. So about 15 points higher from here, there's a gap that presumably would be filled before the market went lower, if it's going to go lower. So I think we're still kind of in the wait and see mode, is my gut feeling. I think you'd wait for a decisive break of this lower trend line, or you could wait for a decisive break of this low right in here around 1890, 1880 to really make a decision on your 401k or your IRA. Now, for those of you that are more shorter term than that, you may make a decision that involves, something quicker than that. Let's look at let's go to the daily chart. Let's look at a 3-month. And you can see that we had this week down. We've talked about this week, and then we had this move back up. And if you look at Friday was a especially interesting day. Let's look at just a 10-day chart here for a second. And you can see we got really close to filling that gap. The gap is up here around, well, let me just show you the gap because I think it's important to, some of you might not even know what a gap is out there. The interesting thing is you can't really see it on the S&P index chart. If we put in a SPY chart, which is an ETF that follows the S&P 500, you can see the gap right there. And on this chart it shows that we filled the gap. But if you look at let's look at an hourly chart. See if we can see it differently on an hourly chart. Let me go to S&P 500. Yeah, see, you can see it here on an hourly chart. This gap right here. Here, let me zoom in again. Kind of get this on the screen. So you can see a gap right here. And you see that that gap has not been filled. It would have to come up into this area around the top of the box, which is, what is that? That's, well, the box went away. So let me see if I can get the box and the numbers on the same chart. It's not going to let me do it. So let me zoom back out and use the software tools here. So we can kind of create a box right here. And you can see that in order to fill that gap, we've got to be up here right at around just over 1970, 1970.22. So, that's kind of what I'm looking to happen. This could be, this looks very corrective to me, but then this could be kind of an intermediate. You could get a pull down into here, maybe even to here, and then it could rise up again to fill that gap. So, we'll look for that to happen. And kind of go from there, but keep an eye on that 1970. Now on the Dow, you really don't have that. You really don't have a gap. You got well, I don't know. I say that there's a small gap here, right here at 16,880. So we could see the Dow. I mean, you might see this pull back a little bit, maybe down into here at 16,500, and then make another push higher to fill that gap. So we're still not, in my mind, we're still not selling off. We could go higher still. So if you're in a 401k, you're in an IRA, I still say sit tight. Mainly just because you don't want to be, your decisions around those types of accounts need to be 30 to 60 day decisions. They shouldn't be weekly decisions and things like that. So, obviously it's your money. You guys do what you want. Now the interesting thing here about the Dow, I'm just looking at this upper trend line. If this took, let's say this week, so 1, 2, 3, 4, 5. So, let's say it got back up to this trend line, the underneath side, or this 2000 and 2007 trend line high. That would put the Dow at around 16,849. So what did we say? 16,880 was the gap. So you could see the market make another push up here a little higher before it sells off, and then we just need to wait and see. Does it break this low? We're looking for a close below this low right here, and I say if it closes below this low right here, we're looking for a much deeper pullback. We can go back on the S&P 500. If we go back on a 5-year chart, we can look at the gap between, well, let me go to a 10 so we can see it's such a big pattern, but we could go, say, from here to here. I'm not sure what that distance is, but I think we figured it out before. It was like, I don't know, 800 points or 700 points or something like that. So what you would do is you would measure from here, so right there, to right right here. So 1217 to 805, roughly 450, 500 points. So once we break out of this pattern, what it could do, again, we have to wait till it breaks out, but what it could do is break out, retest the bottom here after it's closed the gap, and then sell off, 400 points or so. So obviously, if we have a 400 point sell off in your 401k, I mean, you don't want to take on that kind of loss, I wouldn't think. So that's what we're here to try to do, is to protect you from that kind of loss. Let's look at the interest rate market, the 10-year Treasury. Initially we talked about this box being the area of support. Let me go to a 2-year here. And what's interesting is, the box is still holding as support. I haven't made it any bigger here, but I could. The box is still holding as support. We hadn't had a close below it. But I'm not so sure that we're not going to get a new low. I mean, I think maybe you could break this 22.98 area, maybe go down to 22.5. And I would say if we get a close below, say 22.5, let's look at a 5-year. If you get a close below 22.5, you could very well see the 10-year Treasury go back into this area right here to 1.6, 1.62, something like that. So I don't know if this is an uptrend. This area of support should hold, but it may not be the start of an uptrend yet. This first move might not be the start of an uptrend or a trend change. And if it's not, then it could very well come back and retest these lows down here. And right now it's just too hard to tell. But I still say, if you're in bond funds, you should be using this downward movement here, which means your bond funds are going up in value as the yield has been coming down right here, down through this area. You should be making money in your bond funds as it's moved down this way. But when it goes back up this way, you're going to be losing money in your bond funds. And it's very difficult to know whether this is going to go a little bit lower or if it's going to go higher here. But, we're at like 40-year lows for interest rates, so it's not likely that interest rates are going to go lower. It's likely that they've bottomed and are moving higher. So one of the things you have to learn how to do in the marketplace, and this is very difficult for people, is learn how to think in terms of probabilities. The probability is that this is a pullback in a trend change upward, okay? And if this is a pullback, that means the next move is up, and significantly so. Now, so we look for a place to enter, and if it comes up and then turns around and sells off, then we get out of our position, right? I mean, it's a probability. It's not a for sure thing. So that's the way I'm going to help you kind of think about your 401k and your IRA too. Nobody knows the future. It's impossible for me to know what's going to happen tomorrow or next week in the market. Now, we can look at principles like support and resistance and swings, different swings in the market. There's certain technical analysis things we can evaluate to give us an idea of the market's direction or what the market might do next. But knowing, in the sense that you all think of knowing, it's not possible to know. These are unknowable things that I'm talking about. So now what is known are the conditions that could lead to some of this that I'm talking about. We have quite a bit of debt. We've had drop in interest rates for 30 plus years. We've had we've had massive government spending and things like that. That all those kinds of facts portend not the next bull market, but likely some level of bear market. So we can know that, but we still don't know with any certainty from day to day or week to week or even month to month what the market's going to do. So all we can do is let the market tell us what it's doing, and then make a decision as to what we're going to do as a result of that. So that's what we're doing here. I hope I haven't, convince you guys that I somehow know what's happening in the market. There's nobody that knows what's going to happen tomorrow or even next week. So that's unknowable. Let's look at the euro, U.S. dollar. It looks like it looks like the euro is kind of making its way down to this support area that we have, and we're going to watch here to see if it holds. If it doesn't hold, then we're going to go to the next level of support. But I would say, the euro, probably what's going to happen is the euro and the dollar are going to go to some sort of parity. They're probably going to go to where they're equal one another. So instead of spending $1.40 to buy a euro, you're going to basically be able to trade a euro for $1 and $1 for euro. That's probably the direction this is going. Sometimes people call them a pairs trade. So the euro could be going down, the dollar could be going up, and then they meet at 1 equals 1. That may be what we're looking to see happen here. It's hard to say, but the euro looks, at best, it looks like it's consolidating, in which case it consolidate for a little while longer and then maybe continue higher. But it's hard to say what all this is. I mean, this is a 5-year just sideways pattern. So volatility is some of you might have heard it called the fear index. So it's the price. This value reflects the price people are willing to pay for S&P 500 index options. So as volatility goes up, that means people are willing to pay more and more for puts on the S&P 500 index options market. So what that means is they're trying to protect their portfolios. As the market goes down, the VIX goes up. Now, the VIX and the market are not a perfect one-to-one relationship. Really what you're looking for in the VIX is, if we look at last week, for example, we look at a 6-month chart, we look at last week, you can see here when the market was selling off on Friday, the VIX ran way up here, right, all the way to 15. But then as the market, started to quiet down a little bit, the VIX ran back down. So there was initially some fear that drove the VIX up higher, but then the fear subsided and people sold those options and liquidated those positions, and the VIX continued to fall. Now the big thing you look for in the VIX, there's a saying, when the VIX is low, it's time to go, and when the VIX is high, it's time to buy. So you can see here at the March lows, March 2009 lows, the VIX was high or low? Well, it was high, right? It was around 90. So that was the time to buy. The VIX is high, it's time to buy. The VIX is low, it's time to go. So just looking at the last 10 years, would you say this number is high or low? Well, to me it looks low. So again, another reason why the middle class investor began, and the reason I started doing these videos is I just feel like there's a lot of people that don't understand these things and need a little help in making decisions about what to do with their money. Now, that doesn't mean I'm making the decision for you. You still have to make the decision. And you can listen to me and go, hey, that guy's crazy, I'm not going to do it. And that's fine. There's nothing wrong with that. But I'm just here to help empower you a little more so that, you don't sell at the exact bottom and then, beat yourself up and go through that whole psychology of what happens in the marketplace. So again, we've done, again, I think the Dow is pretty key. I mean, we're looking at the Dow here, and you can see this trend line. This trend line goes back almost 20 years, and yet it seems to be important in the market. So, in fact, let's just look at it real quick. Let's put a 20-year chart up, and you can see that here's the 2000 high, and then here's the 2007 high, and all I did was connect this high with this high and extrapolate it out into the future, And then, of course, you can see how, this is the line right here, you can see how critical since really the 1st of June this line has been. We tried to get above it, the market pushed and pulled and pushed and pulled, and then went whoo right through it like a hot knife through butter. And it does look like maybe it's going to try to test it, the underneath side again. Now, we've already pointed out that around 16,880, so let's just go ahead and mark that on the chart, 16,880, there's a gap. So I would at least expect this to, grind its way up into this gap area and obviously either go through it or the gap would, fill, and then the market would resume downward. And then that's when we're going to get pretty aggressive about making our decision. So that's about all I have for this week. It was an interesting week in the market just because it was an up week, but you can see from right here it opened here, it ran all the way up to here. So the Dow ran all the way up to what's that high there? 16,775, and then sold off. And that's usually kind of a bearish signal, although I think it's probably going to run up and test this gap. So just sit tight. It'll probably take all week to grind its way up to that gap. We might be looking next week at a gap, but might be talking about how it filled the gap and now looks like it's selling off. But let's wait till that actually happens, and it'll be that way we can go into some detail about the way it looks, the way the market participants responded to it, and so on and so forth. Follow me on YouTube at Middle Class Investor. You can find me there, or you can follow me on Twitter at Investor Class. And that's it for this week, guys. Thank you again for coming in, and thank you for commenting, those of you that have been commenting. It's nice to have a little feedback. Certainly if you have any criticism, that's fine too, or if there's something in particular that you would like to discuss in this format, I'd be happy to do that as well. So until next week, guys, thanks a lot for coming to the Middle Class Investor. Take care. Bye-bye.